questions about the amount of equity that we're holding. And yes, it does appear very high. And you need to dig down into it to see what the real level is. We don't have much in North America. We've only got about 20% in North America. And that's where the markets are expensive. China, on the other hand, is near rock bottom and is very cheap. And we didn't have much China in FIT, but we did have it in the Global Equity Fund. And our weighting in China is now up to about 20% overall. 75% in equities can be reduced if you take out the stocks which are going to pay. We've got Activision and we've got Distel, which together make up about 3.5%, 4%. And they are going to pay out. So those are pseudo cash. We've got about 4% in utilities, which to me are pseudo bonds. Then you come down to about a 68% level in equities. But our strategy is to be in equities because we believe that the best way to invest for inflation is to be in equities which have pricing power. And so we are comfortable to be in equities. We just need to be in those equities which have good pricing power. And in Europe, we've got stocks like Nestlé's, Roche, and we've also got Anheuser-Busch, which have pricing power. So those stocks are not expensive. And we've got about 2-3% in the Chinese banks, which are earning over 6% in US dollars. They're not susceptible to the equity downdraft in our mind, but they are giving a return better than inflation. So we've got a certain amount of cash. Our cash portion is only 14, but we've also got 6% in gold, direct gold, and we've got 6% in short-dated treasuries. So we're looking at 26% in near cash. And the important thing is to have cash when the markets are low. And if we do get a downdraft, which is quite possible in the US, then we won't be affected too much on that. We do have a short position on US stocks of about 5% of the fund, covering about 7% of the US equities that we have, which may be vulnerable to a sell-off. A lot of the equities that we have are also commodities. We've got big positions in precious metals and copper together, but we also have big positions in agricultural stocks. And the agricultural stocks are doing well, and partly why we've had a good performance in FIT in the first 3 months of this year. Now, do we want to sell those? I don't think so, because that's where the pricing power comes in. If inflation starts to run away, then those commodity stocks are going to do really well. So we're not positioned in S&P stocks. We're not positioned in the big winners of last year, the vulnerable stocks in the market. But we are positioned in stocks which we think are great. So whilst the indices might be high, the equities that we've got are not only cheap, they've got a good runway ahead of them. And I'll give an example. We've got an investment in a defense stock, which is up 80%. We had it before the problems in Ukraine, and that's doing well. We don't want to sell stocks like that. But with events at the moment, there's a lot going on, and there's a lot of movement. Last year, one of the reasons, again, for the underperformance last year, we brought money back from overseas because we thought things were expensive. And we invested them into bonds, yeah. But now we've lightened those bonds. And investing the money in SA, in Rand protection stocks.